profit reports from several big U.S. companies that topped expectations. This is keeping Wall Street on pace for another winning week. Insurance giant United Health Group rallied after it said profit growth during the spring was better than expected. JP Morgan Chase is up as well after it said its profit during the spring grew by more than expected as well, thanks in part to its acquisition of the troubled First Republic Bank. Wells Fargo rose after it also reported stronger profit for the second quarter, better than expected once again. The earnings report season is just getting underway, and Wall Street's expectations are low. Analysts are forecasting the worst drop in earnings per share for S&P 500 companies since the spring of 2020. And if they are correct on that, it would also mark a third straight quarter where profits sank. Such expectations are key for financial markets because one of the biggest factors that set a stock's price is how much profit a company produces. Solid spending by U.S. consumers has been one of the main pillars keeping the economy out of a recession. And thousands of Hollywood film and television actors voted to strike on Thursday. They're joining writers who walked off the job a couple months earlier.
We are the victims here. We are being victimized by a very greedy entity. I am shocked by the way the people that we have been in business with are treating us. I cannot believe it, quite frankly. How far apart we are on so many things. How they plead poverty, that they're losing money left and right when giving hundreds of millions of dollars to their CEOs.
So which films and television shows would be hit by a walkout by the Screen Actors Guild and the American Federation of Television and Radio Artists? Well, a walkout by actors would stop all production of film and scripted television shows in the United States except for independent productions that are not covered by labor contracts with unions. Work on dramas and comedies has already ground to a halt in Los Angeles, according to Film LA, which issues film permits. Production on Stranger Things, The Handmaid's Tale, and other shows have shut down. Now, what will the fall TV season look like? Broadcast networks including Fox and Walt Disney and ABC have announced fall lineups heavy with reality shows, which are not affected by the strikes. ABC will air reruns of hit comedy Abbott Elementary, and Fox will feature an animated comedy that was already completed. Fresh seasons of comedies and dramas that typically start in September will likely be delayed. And what about streaming services then? Netflix, Amazon.com, Prime Video, and other streaming services can continue to supply local language shows made in places like Korea and India, but their Hollywood productions would be paused. And what programming will be safe from the strikes? Well, news programs will continue as normal because their writers are covered by a different union. The same is true for unscripted reality shows like Big Brother and The Bachelor. Now, of course, what about movies? The flow of films into theaters is protected from an immediate hit because movies take 2 to 3 years to produce, but future releases like Marvel's Blade and Thunderbolts have been delayed, and more are expected to be put on hold until the labor conflicts are resolved. Promotional events for forthcoming movies still to be released will be canceled. And U.S. consumer sentiment jumped to the highest level in nearly 2 years in July. This is according to a survey on Friday. The University of Michigan's preliminary reading on the overall index of consumer sentiment came in at 72.6 this month. This is the highest reading since September 2021. Sentiment climbed for all demographic groups except for lower-income consumers. And the sharpest rise in sentiment was largely due to the continued slowdown in inflation and stability in labor markets. Meanwhile, $39 billion in student debt is set to be canceled. The Biden administration says over 800,000 borrowers will have their student debt wiped away in the coming weeks. It says this is due to administrative fixes that more accurately count qualified monthly payments. There are currently several different kinds of repayment plans for borrowers with federal student loans. The plans base payments on borrowers' income and family size, regardless of their total outstanding debt. After reaching a set forgiveness threshold of 20 or 25 years, the borrower's remaining balance is then wiped away. The new administrative fixes presumably result in more borrowers past this threshold. Student loan repayments resumed in October after a years-long pause during the pandemic. The Supreme Court last month struck down Biden's loan forgiveness program that would have canceled $10,000 to $20,000 of debt for millions of borrowers. And big U.S. banks reported earnings today. J.P. Morgan Chase, Wells Fargo profit both surged. It climbed 67% and 57% respectively. Profits got a boost from higher interest rates. The banks are watching for signs whether the economy was slowing and are concerned about losses in commercial real estate. Here's more.
Some of the biggest American banks on Friday reported quarterly results and painted a picture of a robust but slowing U.S. economy. Both J.P. Morgan Chase and Wells Fargo got a boost from rising interest rates, courtesy of the Federal Reserve. For both banks, income earned from interest on loans jumped compared to interest paid out on deposits. J.P. Morgan CEO Jamie Dimon said the economy continues to remain resilient, but that spending was slowing and warned consumers were, quote, slowly using up their cash buffers. There have been growing worries around the health of the U.S. economy against a backdrop of aggressive interest rate hikes by the Fed and high inflation. Investors have worried that high interest rates could push the economy into a recession, but the outlook remains uncertain. Wells Fargo reported that it reserved an additional $949 million in case of loan defaults, mainly in the area of commercial office space. Wells CEO Charlie Scharf said that while the bank hasn't yet seen significant losses in their office portfolio, the bank is reserving funds for weakness they expect to play out over time. Citigroup, meanwhile, said its profit tumbled 36% in the second quarter as softness in the bank's trading business blunted gains from its personal banking and wealth management. Citigroup shares dipped in early Friday trading. Wells and J.P. Morgan were roughly flat. Bank of America and Morgan Stanley announced their results on July 18th, followed on July 19th by Goldman Sachs.
For more on the bank earnings, here with me is Sam Burns, Chief Strategist at Mill Street Research. So, Sam, how would you rate the financial performance of the banks that we got earnings reports from today?
I think overall the reports have been better than expected. All three of the big banks that reported beat consensus analyst expectations for earnings this quarter. So I think overall it's certainly a decent report. There's been some areas of strength and some areas of weakness within a lot of the banks, and some of them were stronger than others. But I think overall there were no major surprises and nothing that would cause a problem for the broader equity market.
Can you speak in slightly more detail about which areas the banks were more profitable?
Right. So generally speaking, most of them said that their net interest income, so the difference between what they charge on loans and what they pay on deposits, was stronger than expected, and actually is expected to continue to increase this year, thanks in large part to the Fed's rate hikes. That raises the amount that they can charge on their loans, and it tends to go up faster than the rates that they pay on deposits. So the profit margins essentially on traditional lending have held up well and are still doing well. And the part that's relatively weak has been sort of the investment banking side, the more Wall Street oriented side of things. But overall, lending profitability is pretty strong. It's a question of the amount of loans being made and then the loan losses on some of them that have crept up in some of the consumer areas.
And are there any worrying signs, right? How are the bank's asset quality?
So far, it looks like they've been pretty good. The loan loss reserves that they've put aside for bad loans have risen, but not dramatically, and they're generally, I think, in line with historical norms and what analysts have been expecting. So there's been no giant surge in bad loans. I think Citigroup reported a substantial increase in the amount they set aside for credit card write-offs. But that, again, was in some ways expected. That's just been part of the cycle as things kind of slow down and interest rates go up. But I don't think there was any major surprises. I think there's been a general increase in loan losses reserves and in credit tightening by banks. They've been tightening the standards that they're used for issuing new loans.
What about the exposure to commercial real estate? Any worries there?
There have been some worries there, and I think particularly Wells Fargo being exposed to some of the West Coast office market there has had some issues there. Again, nothing that was not somewhat anticipated. Most people know that the commercial real estate market has been weak for a while and still is. So then it's just a question of exactly, where the losses are and how they'll be dealt with. But I think in general, they have the balance sheets to handle it. It's not going to be a major issue for these banks, but it's just a question of how much pressure it puts on earnings over the next few quarters.
What about liquidity position? Are they well capitalized?
Generally speaking, yes. I think most of the banks have sufficient capital. I think some of them went through a stress test by the Fed recently and passed. So I think generally speaking, their balance sheets are in good shape, particularly for the big banks. Some of the regional banks, which we'll hear from a little later on next week, some of them may still have balance sheet issues, kind of along the lines of what we saw, back in March and April from Silicon Valley Bank and some of the other ones where the losses on their bond holdings caused them problems. But the big banks like JP Morgan and Citibank and Wells Fargo, they're much more diversified and they don't have those kind of problems to the same extent.
Yeah, and it does give us a glimpse into how the economy is doing. I want to ask you, how does the consumer look right now?
The consumer tends to be holding up pretty well. I know JP Morgan has made some comments that they thought consumer was doing well. The labor market and wages have been pretty strong still, so it gives people income to spend. Credit card usage has risen, but I think the overall aggregate credit card debt has been slowing a little bit lately, and banks have been a little more conservative with their loans. So I think the overall pattern for the economy in terms of consumer spending has been positive but not extreme. So I think it's more a matter of consumer spending in line with their income growth rather than taking on dramatic levels of new debt.
Is the possibility of a recession still on the horizon, or has that been eliminated?
I think it's probably unlikely, near term this year. It's always certainly a possibility next year. And the question will be, to what degree has the cumulative effect of the Fed tightening going to spill over into business spending and then consumer spending probably next year. But so far, the strong labor market and the housing market have held up better than most have expected. So I think the recession odds have been lowered from what people thought at the beginning of this year to pretty low levels now. I think people are still a little worried, but I think overall the recession odds are pretty low for at least the next 6 months or so.
I mean, from the earnings report, as long as the consumer keeps spending, I think the recession could be kept pushing further and further away.
That's right. That's right. I think the strength of the labor market and the support from fiscal policy in terms of infrastructure spending and things like that have really helped offset a lot of the impact of what the Federal Reserve's rate hikes have done in terms of raising interest rates and mortgage rates and things like that. So I think that balance has been different this cycle than in a lot of past cycles, and that's why we're seeing a lot of things kind of hold up better than a lot of people were worried about earlier in this year.
So the earnings reports come off the banking troubles we had a couple months ago. Is that behind us now?
I think the worst of it is, I think some of those regional banks, the smaller banks, are still struggling. When I look at the earnings estimate data that I track, a lot of these smaller banks are still seeing their estimates being cut, even now, going after 2 or 3 months later. So I think there's a lot of those smaller banks where there's uncertainty about what their balance sheets are going to show in terms of losses from bond holdings. But I think a lot of that has now been priced in. The stocks have been knocked down pretty good, and a lot of analysts have kind of factored that in to some degree. So I think there may not be as many big surprises now, but that doesn't necessarily mean the news will be a lot better. It'll just be having been priced in now.
And it seems like the markets like the earnings report this morning.
Yeah, I think generally speaking, the fact that there were no big negative surprises and that all three of the big banks did beat their consensus earnings estimates gave the kind of overall market, at least a little bit of a boost. No reason to sell essentially on that news in terms of what the banks told us.
What do you think about the earnings estimates? Being cut, right? We get higher earning estimates, and then as we get closer to earnings season, they get cut.
That's right, and that's a fairly typical pattern for analysts as the end of a quarter approaches. They tend to reduce their estimates to kind of make sure that the companies can beat them in a lot of ways, and then adjust once they see the news from the company and the guidance. So that's a fairly standard pattern. That's kind of what we've seen here. The worry is when the earnings estimates really go down more aggressively going into an earnings report, and then if the company doesn't meet estimates or guides future earnings lower, which is what the risk is more for maybe some of the capital markets companies or some of the smaller banks that we'll see over the next week or two that'll be reporting. And so that's really the worry. The really big banks like the ones we saw today are probably less risk because they are more diversified.
Do you have this worry that we may be setting the bar a little bit too low with these earning estimates?
At this point, no. I think last quarter the estimates were probably clearly too low, and estimates generally came in significantly better than expected for Q1 earnings. For Q2 earnings, I think analysts have adjusted somewhat, and I think estimates will still be actual reported, will still beat the estimates as they typically do, but probably not to the same degree now that analysts have kind of adjusted to the fact that earnings are coming in a little bit better than expected. So there'll be probably fewer surprises and probably more of a normal earnings season this quarter, I would imagine.
Coupled with the CPI report, which was pretty good, and the earnings report we got today, is all-time highs in the stock market in the headlights now?
Certainly a possibility. I mean, the S&P 500 is only about 6% away from its peak from early last year. So it wouldn't take a huge amount for it to get over that. I do think we've made a pretty big run in a fairly short period of time now, and positive responses to the inflation data and earnings, I think have helped the market get to where it is. The question is, how much further it can go unless there's, additional good news, which we might get from Q2 earnings and guidance. But my guess is that we might have to see some consolidation first before we make the next leg higher towards the old highs.
Sure. Do you think that we've deviated too much from fundamentals?
Not really, no. I think sentiment has really kind of been the swing factor here. Most people got very negative late last year and early this year, and now the sentiment, kind of the perceptions have been improving, and that's what's driven equity markets higher. And actually helped the credit markets as well. So I think there's probably a little bit further of that to go. I think to adjust to the kind of conditions that are not as bad as people expected. But I think there's some of that has already been done. So I think there's probably a little bit more upside and maybe some consolidation to come now that we've made a pretty big move in equities. But overall, I don't see a lot of downside from here in terms of the fundamentals.
Sure. I mean, a 3 to 5% correction is pretty normal given any year in the stock market, right?
Oh, right, exactly. Yeah, that's very standard kind of volatility in the short run, and the S&P is up quite a bit this year, 17-18%, and so it would be not at all surprising to see some consolidation or pullback once the sort of the good news has come out. I think if people expect the Fed to be a little more moderate and for growth to hold up, the kind of soft landing scenario to play out, then that would maybe give the rest of the year a little bit more of a boost. But I think it's more a matter of expectations adjusting to where reality has been, as opposed to reality being extraordinarily good.
Okay, Sam, just one last question. I'm curious about this. NVIDIA, 30, 40 times price to sales. I mean that's got to be deviated from fundamentals, right? I mean, with competition increasing, it's hard for me to see how it can justify that.
Yeah, you're right. I mean, some of those big tech names like that have had really big runs and that are tied to kind of the AI boom that people have been talking about certainly are at risk from some of their valuations, I think. I mean, certainly people underestimated their earnings power, last year and have had to catch up. But then eventually, yeah, the stock price can get ahead of almost any positive fundamentals that they may have. So yeah, there's definitely some risk to some of those names that have had really big runs. And then the question is, to what degree does money rotate out of them and into other stocks as opposed to rotate out of the market in general? And I think that's what we might see is some rotation from some of those big names, big tech-related names, and into other areas of the market.
Yeah, I mean, that would be interesting because we just had a rotation, right, from last year. But anyways, thank you so much today, Sam. It's a pleasure speaking to you.
My pleasure. Thanks for having me on.